Welcome to Talk Tickers. We're your shortcut to staying informed on the latest earnings calls.
And today, we're diving deep into Welltower's Q3 2025 results.
Yeah, this wasn't just your standard quarterly update. I mean, it was pretty seismic. We saw a massive $23 billion strategic overhaul announced.
Right, essentially marking the launch of what they're calling Welltower 3.0. It felt like a real watershed moment for the company.
Definitely a full structural shift underway.
So our mission today is to get past just the headline numbers, which were strong, don't get me wrong.
Very strong.
But really unpack this dramatic kind of all-in strategic pivot. It's clearly designed to capture long-term growth in seniors housing.
Okay, so let's kick off with that operational snapshot then. The financials, they look decidedly bullish, wouldn't you say?
Absolutely. Though the market reaction was a bit nuanced. We'll get to that.
Okay. So normalized funds from operations, FFO per share, that landed at $1.34.
Which comfortably beat the $1.30 consensus estimate. That's a 20.7% jump year over year. Pretty powerful.
And revenue also topped estimates, coming in at $2.686 billion. Big numbers.
The operational strength is, it's undeniable, but it's worth adding some context here.
Right.
The GAAP earnings per share, generally accepted accounting principles that actually missed consensus, came in at $0.41.
Why the gap?
Well, when you're making these huge portfolio moves, taking charges, you often see this kind of divergence, sort of expected.
Okay.
But the market seemed to focus right away on the underlying operational momentum.
And that momentum looks phenomenal. Total portfolio, same-store net operating income, SSNOI, grew 14.5% year over year.
But the real engine, as you know, is their senior housing operating segment, the SHO business.
Yeah, that's where the action is.
And it's delivered an incredible 20.3% SSNOI growth.
20.3%.
Yeah. And get this, that's now the 12th consecutive quarter that SHO has posted growth over 20%.
12 quarters. Wow. That level of persistence, it just speaks volumes, doesn't it?
It really does.
Yeah.
And that SSNOI boost, it came from both volume and price. We saw occupancy jump 400 basis points.
Significant gain.
And RevPR growth, that's revenue per occupied room, was up 4.8%.
So RevPR, just quickly for listeners, that's basically what they earn per resident rent and services combined.
Exactly. And the key insight, like you said before, is that RevPAR growth easily outpaced their expense growth.
Right, which drove, 260 basis points of margin expansion?
That's it. Pure operating leverage kicking in. You'll love to see it.
Okay, so given that beat, the strong operations, the guidance raise that followed, you'd think the stock could have, soared.
Right. Pre-market indications were pointing towards maybe a 4% jump.
But that's not what happened.
No. Here's where it gets interesting. The shares actually faded through the day and closed down 1.6%.
So why the fade then? What's the thinking there?
Well, context is everything. You look at Welltower's run, the stock was already up over 46% year to date leading into this call.
Okay, so a hot stock.
Very hot. So this dip, it really smells like tactical profit taking. People locking in gains.
Right. Not necessarily a rejection of the results or the strategy.
Exactly. It doesn't feel like a fundamental negative view. More like, okay, bank that run. Let's see what happens next. The underlying growth story management laid out seems totally intact.
And that story was strong enough for them to raise their full-year normalized FFO guidance pretty significantly.
Yeah, they bumped it up to $5.24 to $5.30 per share.
Which was up from, $5.06 to $5.14 previously? That's a decent jump.
It is, and management was very clear, tying that raise directly to higher SHO NOI, so continued operating strength, and highly accretive capital allocation. Which, that brings us straight to the big pivot, doesn't it?
It does. Let's shift gears then. How are they actually planning to execute this massive transformation?
The scale is almost staggering.
It really is. We're talking approximately $23 billion in transactions announced, all aimed at solidifying their focus.
Which is to become a, quote, pure play rental housing platform for the silver economy. That's the mission statement. And that $23 billion breaks down into roughly $14 billion in seniors housing acquisitions.
$14 billion. Wow. How many properties is that?
Over 700 properties, more than 46,000 units across the U.S. and the U.K. They're scaling up aggressively.
Including some major names.
Yeah, bringing big portfolios like Barchester and HC-One under the Welltower umbrella.
Okay, so big buys on one side. How are they funding it?
Mostly through selling non-core assets. Around $7.2 billion worth of their outpatient medical portfolio, the OM assets. That's 18 million square feet.
That's a huge divestiture. Is it just about raising cash?
Not entirely. It's also an operational cleanup. They're getting out of the OM property management business completely.
Okay, so simplifying the business.
Exactly. They mentioned over 160 colleagues transitioning to the buyer. It lets them focus resources laser-like on senior living. The CEO really emphasized that simplification is key for the next phase.
Okay, but selling off all that OM, doesn't that raise questions about concentration risk? I mean, outpatient medical is seen as pretty stable, diversifying. Now they're doubling down hard on the more cyclical senior living sector. Is that a huge bet?
It absolutely is a massive bet, no question. But look, it's a bet backed by demographic certainty, right? The aging population wave isn't going away.
True.
And they seem to have mitigated some of the financial risk through some creative deal structuring on that OM sale.
How so?
Well, they didn't just sell the whole portfolio outright for cash. They actually kept a piece. They retained a $1.2 billion preferred equity stake in the portfolio.
Okay.
And that pref comes with an 8% coupon. So steady cash flow coming back to Welltower.
Interesting. An 8% coupon plus anything else.
Yes, and this is the really clever part, arguably. They also kept a 25% profit interest in the future performance of that OM portfolio.
So they get income now and potential upside later. Why is that smart?
Because it essentially acts like a risk-free call option on that portfolio's value. They get immediate cash flow from the 8% coupon, which is great. But by keeping that 25% profit share, they still participate if those assets appreciate significantly down the road.
Without having to manage them or tie up capital running them?
Precisely. They capture upside while freeing up billions in liquidity right now. It's quite elegant, really.
And that liquidity position looks pretty robust, nearly $11.9 billion available.
Yeah, substantial. Now, their leverage, net debt to adjusted EBITDA, was actually at a record low before this, 2.36 times.
Yeah, really low for a REIT.
Extremely low. They do expect it to tick up by about 1 turn on a run rate basis after all these deals close.
But critically, they're fully funded for this entire acquisition pipeline already. No financing contingencies hanging out there.
Correct. The capital is lined up.
Okay, let's loop back to operations for a second. We talked about that incredible SSNOI track record, 12 quarters above 20%, driven by their tech and data platform, the Welltower Business System, or WBS. So it raises that classic innovator's dilemma question, doesn't it? If you're winning this big already, why rock the boat? Why this massive Welltower 3.0 disruption?
Yeah, it's a fair question. They actually used the Netflix analogy on the call.
Yeah.
You know, if you don't disrupt yourself, someone else eventually will.
Okay. Get ahead of the curve.
Exactly. So Welltower 3.0, it's more than just transactions. It's presented as a philosophical shift, moving from being primarily a capital allocation machine.
Which was kind of Welltower 2.0.
Right, to now being an operating company in a real estate wrapper. Operations and technology first. That's the mantra.
So what does that mean in practice? What's the goal of W 3.0?
The stated goal is maximizing growth by aggressively reducing latency in their system.
Latency, meaning?
Just inefficiency, friction, delays, anything that slows down the process or increases cost.
Yeah.
They gave some really tangible examples of how their digital transformation, powered by that WBS platform, is delivering faster cash flow. Well, think about finding new residents. They said they've reduced the time it takes to respond to a prospect from potentially days, or even just an unanswered call.
Which happens a lot in this industry, unfortunately.
Right, down to single-digit minutes. That's huge for conversion.
A massive difference. Any operational examples?
Yeah, getting rooms ready for the next resident. They cut the average time to turn a vacant room from 37 days down to just 11 days.
Wow, 37 down to 11. That's huge operational alpha. Faster move-ins, lower vacancy loss, higher occupancy, it all flows through.
Directly to the bottom line. And it's driven by data and standardized processes via the WBS.
Okay, but maybe the most compelling part of this whole pivot, or perhaps the most radical, is the change to incentives.
Agreed. They're talking about ensuring every participant acts like an owner, really aligning the entire ecosystem.
Starting right at the very top with the executive compensation.
Yeah, the named executive officers, the EOs, big changes there. They're moving to a flat $110,000 base salary.
Just $110K base for top execs at a multi-billion-dollar company.
That's it. Plus long-term OP units, essentially equity in the company that vest over 10 years.
10 years, that's a serious commitment, almost unprecedented, isn't it?
It really signals they are all in, betting their prime earning years on this W 3.0 vision succeeding. Their wealth is now completely tied to long-term total shareholder return.
Removes any temptation for short-term moves that might hurt the long game.
Exactly. Pure alignment with shareholders over the long haul. And they expect this new comp plan to actually be accretive to FFO starting in 2026.
Okay, so that's the top brass. How does that alignment trickle down?
Down to the operating partners, the companies that actually manage the day-to-day in many of these communities. They're introducing something called the IAA 6.0 structure.
That's their performance-based incentive structure, right? Residency and incentive development agreement.
That's the one. IA 6.0 basically ensures that the wealth creation for these key operating partners is also irrevocably tied to Welltower stock performance.
So everyone's rowing in the same direction, tied to the same outcome, wealth stock price.
Pretty much. They said the founding class of this new IRD program already represents about 20% of their current SHO net operating income. So a big chunk of the operator base is now directly aligned.
That's powerful. And there was one more piece of alignment right down at the community level.
Yeah, and this one might be the most impactful culturally. Management is setting aside a $10 million annual grant in Welltower stock, specifically for the site-level employees.
The frontline staff, caregivers, nurses, community directors.
Exactly. At the 10 best-performing senior housing communities each year.
Wow. That's genius. Direct incentive for retention and keeping residents happy right where the service actually happens.
It's aimed squarely at that. Customer focus, employee retention. Management kept stressing that real value creation is about the duration of growth.
Right, not just next quarter's numbers.
They explicitly said they're willing to take actions that might look dilutive in the near term, like investing heavily in the 170 new communities they have in lease-up right now.
Which drag on current earnings.
Correct. But they see it as building significant opportunity for 2027 and beyond. They're playing the long game.
Accepting near-term, let's call it pain, for that durable long-term growth, because the opportunity cost of not focusing on those highest growth assets is just too high.
Got it. Which neatly brings us to our This Is Not Financial Advice segment.
Right. Time to pitch an outrageous but plausible trade idea based on all this strategic clarity. Lay it on us.
Okay. The setup, as we've discussed, is pretty clear. Welltower is executing this huge, well-funded pivot into high beta, high growth SHO. Demographics are at their back. They're shedding complexity, locking in liquidity. And that little stock dip post-earnings maybe creates an interesting entry point.
Okay, so what's the trade?
The pitch. Consider initiating in a duration arbitrage trade.
Duration arbitrage. Explain.
You short the broader, slower growth real estate benchmark. Let's use the XLRE ETF as a proxy.
Okay, short the general real estate ETF.
And use those proceeds to go long Welltower equity, go long well.
Right. Why short XLRE specifically?
Because that ETF, like the broad real estate sector, still has significant exposure to the slower-moving, more traditional asset classes that Welltower is actively getting out of. Think triple net lease, traditional office, diversified stuff.
Gotcha. So you're betting against the sector as well is leaving.
And betting on the sector well is doubling down on senior housing, powered by their operating platform. The core bet is simple. The market is mispricing the duration and the durability of the growth embedded in this Welltower 3.0 pivot.
You're betting that the WBS operational alpha and the singular strategic focus will decisively decouple Welltower's performance from the rest of the sort of sluggish real estate pack.
That's the thesis. And the catalysts you'd watch are, first, the successful closings of that $7.2 billion OM divestiture. Remember, those are staggered through mid-2026. Each closing de-risks the plan and provides capital.
Okay, OM sales closing on time. What else?
And second, just sustained proof points in the quarterly numbers. Keep seeing that SSNOI print above the 20% threshold. That proves the operating leverage story is real and durable.
Right. It confirms the WBS is delivering and the strategy is working.
It's definitely a high conviction thesis.
Yeah.
It rests entirely on management executing this operations first roadmap they've laid out.
Okay, so let's recap this deep dive then. The Q3 call wasn't just a call, it was really a transformation announcement.
Absolutely. The $23 billion pivot provides incredible strategic clarity. Single focus on senior living now.
And that operational alpha generated by the Welltower Business System, it's just undeniable at this point. 12 straight quarters of 20% plus SHO growth is hard to argue with.
Very hard. And then there's the launch of Welltower 3.0 itself, backed by that pretty radical incentive alignment.
Yeah, tying executives to a decade of performance, tying operators to the stock, even giving stock to frontline staff. It signals extreme internal confidence.
So we've got serious skin in the game across the board now.
So wrapping this up, what's the key takeaway or question for you, the listener?
I think the core question is this. Will this singular focus on senior living, combined with the aggressive reinvestment into these higher growth cash flows, will it ensure durable enough per share FFO growth?
Growth sufficient to justify its current valuation, especially as those OM sales keep providing fuel over the next 18 months or so.
That's the multi-billion-dollar question investors have to grapple with.
And just a reminder, of course, our discussion today, including that trade idea, is purely for informational purposes.
Definitely not financial advice. We've given you the analysis of the roadmap. You have to decide your own investment journey.
Thanks for diving deep with us here on Talk Tickers.
We'll catch you on the next one.